Well, if you're planning on exiting a deal in the next 24 months and you've got a prepayment penalty, is that wise? Once again, it depends. Hello and welcome. My name is Gino Barbaro, one of the co-founders of Jake and Gino. And in this how-to video, we're going to be discussing questions that a limited partner needs to ask a general partner or a sponsor of a deal when it pertains to the debt or to the financing. So if you're looking to avoid the mistakes that passive investors and real estate active investors have made over the last 2 years when it comes to financing, you need to stay tuned to this show. At Jake and Gino, we like to say buy right, manage right, and finance right. Now, there's nothing wrong with short-term bridge financing if you understand how to use it and if your exit strategy applies and you can actually say to yourself, well, I need to get out of this deal in the next 2 years and I can make it happen. What we saw over the previous few years is that people got into bridge debt. They had no experience or limited experience. They had no systems. They got in when the interest rates were low. They didn't expect interest rates to skyrocket. One of the ways that you go out of business in multifamily, in real estate, is you run out of time. And that's what's happening right now. There are vast opportunities right now in the market. And that's why, to me, this video is so important, because if you're a passive investor, you've never invested in real estate, and this really pertains to active investors, whether you're a GP, whether you're a sponsor, or whether you're doing your deals for yourself, it's really important to understand the financing side of it. So what's the first question, to ask? When you're looking at a deal, ask, what's the principal loan on the deal? How much debt are we taking out on the deal? It's important. What's the LTV in corresponding to the deal? Now, it's really interesting with loan to value, because when Jake and I started, we were getting 80% LTVs every day of the week because deals worked. As far as cash flow, you could put 80% as a loan, put 20% down, and you were generating 10% cash on cash returns back in 2013, 14, 15, 16. All of a sudden, 2017, things started to happen. Prices rise. So when prices rise, you need to take out more debt. DSCR goes down. Your debt service coverage ratio goes down, starts dipping below 1.2. So what do you need to do? You need to bring more money as part of the down payment. And we saw in 2021, we saw in 2022 and 2023, all of a sudden, LTVs in a lot of these deals, the loan to values were 65%. Well, when you generally have to put more money down in a deal, your returns are going to be less. So understand what it is. Now, there's a flip side to it. It's also great if you're working with a sponsorship group, they don't have a lot of experience, and they're saying, yeah, we're going to get an 80% LTV loan. Well, does that loan make sense for the deal? Are they taking on too much risk? That's important. 65% LTV, you may feel more comfortable because they're putting down more, right? There's less chance of that deal, quote unquote, going bad. But as we've seen, a lot of LP equity is being written down over this past 12 months, and I think going forward as well. So just be very careful. Understand what the loan to value is. Now, Jake and I, we're launching a program called Passive Investor Pro. It's going to teach passive investors questions you need to ask, whether you're vetting a sponsor, understanding the math behind investing, understanding the team that you need to build, whether you have a securities attorney, whether you have a cost segregation, whether you have a CPA, 1031, asset protection, this whole team members as far as passive investing. We're going to teach you active investing as if you were actively investing in this deal, but taking it from the passive investor's lens. If you want more information, 865-800-3905. If you want to reach out to me, Gino at jakeandgino.com, I'll send you our Will Our Profits book for free, a PDF copy. You can start your journey, because I think as a passive investor, you need to learn the framework. Buy right, manage right, finance right. Once you've learned the framework, you've understood the math, you've understood the markets, you've understood the financing, which we're going to dive into a little bit more here, then you can start making educated decisions. That's what's important. Now, the next one, this is really important. What are the interest rate terms, and are they fixed or adjustable? Now, if you had gone into a deal 24 months ago, you probably would have been quoted 3.5%, but it's fixed for 24 months. What does that mean? It floats or it resets. There's the risk. Now, if rates had stayed between 3.5% and 4%, you would have been okay. Rates would have gone up a little bit, but what happened is all of a sudden, rates shot up 11 times because inflation was not transitory. Let me repeat that again. Inflation was not transitory, and the job of the Fed is to take control and make sure that inflation does not go out of hand. That's why they shocked the system and raised interest rates so quickly. Well, those people, those investors who invested in deals that had short-term bridge financing got caught. So going forward, ask what type of debt it is and assess, can this group get the business plan done in this time frame allotted? Can they increase NOI by X amount? And is the exit that they're planning in the next 2 years, can they hit that debt service coverage ratio? Those are all important questions to ponder. But for us, we haven't liked using short-term bridge financing. We'll use something called a loan to cost, where we'll get typically 80% of the loan and the loan proceeds to doing the rehab into the loan itself. We get a couple of years of interest only on the front end, and we'll also get a 5-year term, much longer runway, so that once that deal is stabilized, we'll be able to go, and we typically use community banks or credit unions. We'll go from that entity and we'll roll it into a Fannie or Freddie product. This next question, is there a prepayment penalty involved? It's interesting that most investors, when they start out, they don't think of an exit strategy. We talk about the 3 pillars of real estate: market cycle, debt, and exit strategy. Well, if you're planning on exiting a deal in the next 24 months and you've got a prepayment penalty, is that wise? Once again, it depends. How much is the prepayment penalty? And on top of that, when you're asking about a prepayment penalty, ask them if the loan is assumable. Because right now, the saving grace for a lot of sponsorship groups, a lot of investors, including ourselves, the loans, if you can assume them now, and we sold a deal on a loan assumption a few months ago, the interest rate on the loan was, I think, 3.5%. In this environment right now, you're looking at 6.75%, 6.5%, 7%. If they can assume a loan at that low interest rate, your property and your loan has value. So ask about the prepayment penalties and ask if the loan is assumable. This next question is really important. Is the loan recourse or non-recourse? Typically on these larger syndications, loans tend to be non-recourse. The sponsorship group signs up, they sign their debt, the limited partners, the risk that they have is attributable only to that deal. They're not taking any other risk. If this deal goes bad on a non-recourse deal, the general partnership, they're the ones who are on the hook for the deal, right? That's important. It's non-recourse. It's just for that deal. The unfortunate thing is if you're on a non-recourse loan and you're, a general partner or you're part of the sponsorship group that's signed on the loan, it's going to be very difficult for you doing deals going forward. That's just the reality. Recourse, if you're a limited partner and you sign a debt deal that's got recourse to it, well, your group, whoever it is, they have liability to that deal. So let's say, for instance, you buy a deal for $1 million, that deal sells for $900,000. You lose money on that deal. You're responsible for the amount of loss, not for the entire loan itself, but whatever the bank cannot recoup. So understand the difference between recourse and non-recourse. We work with community banks and credit unions. We have a decent amount of recourse debt. We're comfortable with it because we know in the long term, we're going to get it over to agency, which is non-recourse. Now, these questions right here, I'm going to follow up and finish up with some questions that I want you to think of as alignment questions. Are you aligning yourself with the sponsorship group, with the general partners? Ask them, number one, what are your fees? What's your acquisition fee? If you're doing a $10 million deal and acquisition fees are anything above 3%, that may be a little bit onerous. Who's to say that deal may be smoking? It may be amazing, and you'll be willing to pay 5%. I'm not here to tell you what's right or what's wrong. What I'm here to tell you is go out and sign up to as many sponsorship groups, as many syndicators out there, and see what's going on today in today's market. Ask them what the co-promote is. What's the split? Is it 70-30? Is it 80-20? Is it 90-10? Once again, I'm not here to tell you what that looks like. Just see what other groups are going out there. I mean, typically right now, we're seeing a 3% acquisition fee on deals around that size, a 70-30 split. And what we're seeing as far as preferred rates of return, a preferred rate of return is a return that goes entirely to the limited partner group. And then anything above that typically gets split, or it can be a catch-up. So let me give you an example. If I've got a deal and I have a preferred rate of return of 8%, all 8% of the first 8% of that cash flow goes to the limited partners. Anything above 8%, we did in our deal, anything from 8% to 11%, us as the general partners got it. Anything above 11% and beyond, it got split 70-30. So understand the structure of how that preferred rate of return is, and then also what they call it the waterfall structure. How does that actually break up at the end of the deal? What does that look like at the end of the deal? And it's interesting. I think this other question, I mean, we're talking about fees. What other fees are incurred? What kind of property management fees, if they're self-managing it? What type of asset management fees? Is there a disposition fee? Is there a refinance fee? Now, I'm not hating on fees because we were a syndication group. We've syndicated 3 deals. There's a ton of work. You need to keep the lights on. You need to compensate your team fairly well. But what does fairly well look like? Can you still create massive value for your investors? And you as a limited partner, when you're looking at this deal, is it seem as if your interests are aligned with the group? I think one question that I really would like to share with you, it's not on this, we're talking about financing, but talking about fees and all, make sure that this sponsorship group, are they putting any money into their own deals? Once again, it's not that I'm not going to invest because they don't invest money into their own deals. It's just I'm looking at it from an alignment of interest. If they have no skin in the game and this deal goes south, are they going to chase hard and try to really get that deal done and try to fix that deal? Or are they going to chalk it up and say, hey, we've got no money in this deal, we're going to walk away? That's just some food for thought. I'm trying to help you as the passive investor align your interests with a general partnership group. And if you're a general partner and you've got your hat on and you're trying to raise capital, I want you to look at it from the limited partner's perspective. Take yourself out from your role and look at life, look at the deal from a different lens. I think it's going to help you be able to raise capital a lot easier. It's going to be able to help you solve problems for limited partners, and it's going to allow you to align your interests with the limited partner's interests. The better you can be in alignment with your investors, the easier it'll be to raise capital, and I think the easier it'll be to actually create the business plan and to nail that business plan. Now, as I end this how-to, it's really important to think of that 3-step framework as the passive investor. You've got the jockey, which is the sponsor. We've been talking about the sponsor a lot in this video. That's the most important thing that you're trying to focus on as that passive investor. The second one is the saddle. You're sitting on a horse, but on top of that horse is the saddle. That's the alignment of interest that I've been talking about. And the third one is the horse itself. That's the deal. Don't worry about whatever deal you're looking for. You need to focus first on the sponsor and then on the alignment of interest. And now, as we're talking about the questions, now these questions you can ask. If you haven't satisfied the first 2, don't even focus on the deal itself. I want to thank you for spending part of your day with us, and we will see you on next week's How-To. Thanks for tuning in. If you enjoyed today's video, be sure to like and subscribe so you'll never miss another episode.